Hello everyone, my name is Deepak and I'm a tax code advisor. Just a few minutes ago, I was talking to a real estate agent um, who specializes in short-term rentals. And short-term rentals are indeed wonderful ways for reducing taxes. And his emphasis was so much on a real estate strategy that made me think that so many people perhaps think that this is the only way to save taxes. And if they cannot get into short term rental, then there's nothing else they can do. Second thing I see is that people get into short term rental, but they don't really end up making um, a decent ROI or even break even many times. And they got into it not because they wanted to get into a short term rental business, but they got into it because somebody sold them a strategy that by being on short term rental, it can significantly save on taxes, which sometimes can be true, sometimes that is not true. That's why you need a comprehensive consultation around that. What's the impact on your taxes will be, but more importantly, what's the impact on overall finances? It's not just about tax, it's about being able to look at the maintenance, being able to look at the location, the supply, the demand, total cost, and what is your long term exit strategy, all that stuff. So it can't really depend on somebody trying to sell you a real estate for all those kind of answers. I think you should use real estate agents for finding good locations, for collecting information about your local market that perhaps you are not able to find it elsewhere, building a good friendship with people who can help you connect with other opportunities in the market. I think real estate agents are great for all those kind of things, but we should not be taking like an investment advice from them. We should not be relying on numbers from real estate agents, and certainly not for tax advice. I think they are not, that's not their specialty. We should really seek out an independent opinion on those matters. So today I want to talk to you about some of the other ways to reduce taxes. And one of the most widely recognized and perhaps historically people have been using it the most is oil and gas. So oil and gas basically involves around putting money into companies that drill wells to extract oil and natural gas from the earth. Though, in a simple term, this is how it works. A company drills a well to extract oil and gas. Oil or gas is extracted until a well is depleted. So you're not going to take all the oil and gas out on day one and sell it. It might take you 5 years, 10 years, 15 years, 20 years. Not all the drills are the same. Some drilling is speculative in nature, that they're trying to figure out if there is a oil there or not. Some are a little bit more concrete. They already know an oil is there and now they just need to drill it. And not all oil drills are same, because sometimes there's oil for last, you know, that will last you 10, 20 years, and sometime maybe 2 or 3 years. So all those kind of problems exist when you look into oil and gas. Now, the oil or gas is obviously sold to a third party, and the profits are distributed back to investors. So, like real estate, oil and gas investments generate cash flow. So, I like that. But instead of rent payments, you get money from selling oil and gas. That is the basics of it. So, today I'll talk about how you can use this to reduce your taxes. What are some of the things that you should watch out for? And obviously, if you want to learn more about these and how they impact your taxes, you can definitely reach out to me and I'll be happy to answer those for you. Now, one of the biggest problem I run into with not just oil and gas, I guess even in other businesses, is that there's a lot of risk with it because there's a lot of bad apples in the market. So you do need some help in being able to identify some of the good companies, some of the best ones out there, and eliminate all the bad apples there. Now, does that reduces your risk to zero? No, perhaps you can still have some risk, but still your chances of making a mistake significantly reduces. So that's what we're going to discuss today. So let me share some slides with you and we'll talk about this. So let's talk about how do taxes work for oil and gas investments. We need to pay attention to two type of cost. One is TDC and the other one is IDCs. So these TDCs or tangible dwelling cost are 100% deductible, but you got to write them off over the 7 years. So normally in a project, maybe 20 to 40% of your overall cost will be related to tangible dwelling cost. These costs are related to an actual equipments. And the reason why they're set up that way is because that equipment perhaps can be reused, or maybe you can sell them. So you get a little bit less deduction on TDCs. However, your IDCs or intangible dwelling costs, they represent almost 60 to 80% of your overall project, and they can be written off 100% within the first year. So that's where a lot of that tax benefit come from. So people love these IDCs. Now you may ask, what are IDCs? These are things like your drill bits, your labor costs, your fuel, um, your supplies. So all of that stuff is considered IDCs. So people love these IDCs to reduce their taxes. So I'll give you an example. Let's say if you invest about $100,000 into an oil and gas project, you can roughly deduct between $60,000 to $80,000 in the first year from your taxes. Now, remember, I'm talking about deduction. I'm not talking about credit. Meaning, let's say if you're able to deduct 80,000, that doesn't mean you're writing off the entire $80,000 off your tax return. You're getting $80,000 of income that you don't pay tax on. That's what that means. So depending upon what tax bracket you are in, so it's really beneficial for people who are in higher income tax states like California or New York or some of the other places. But let's say if you're in Texas, then maybe not bad. But again, we're primarily concerned with federal taxes right now. So I guess as long as you're in a higher income, this will still benefit you no matter which state you are in. Now, this means you can reduce your W-2 income, your 1099 income, any other, even capital gains. So it's a standard deduction. It applies to your overall income. So it's not like it only works for this type of income, for only active, only passive, whatever. It's a pure deduction. You can use it any way you like it. Obviously, most people would prefer to use it for their W-2 because that's the highest uh, tax rate. Now, depletion allowance. So this is another benefit. It's a special tax rule where anywhere between 15 to 30% of that income from selling oil and gas is completely tax free. So you invested in oil and gas project, you took the tax deduction, now you have income depending upon how much oil or gas in that well is. Let's say that income going to last you 20 years. That means 15 to 30% of that income every year is completely tax free. Every time you receive a profit from that well, portion of that comes to you without you having to pay taxes. Rest you do pay taxes, but then you can always take some money and put it back into oil and gas and take deduction on that income as well. So it's a win-win situation. In matter of fact, many people use it as an ongoing strategy. It's not something you use it once every 5 years to 10 years. There are people using it almost every single year. So whatever you like to do, depending upon your income situation. Now, working interest versus a royalty interest. So this is an interesting one. You own a share of wealth and share in the cost and profits. That is working interest, meaning your direct participation in that business. You get the maximum tax deductions because you pay part of the drilling and operation cost. You share in the cost, but you also share in profits. Now, this is the kind of business model that I like, but this is not the only model. The other model is called a royalty interest. That means you own a percentage of the oil and gas extracted, but you don't pay for drilling or operation costs, meaning you're reducing your risk. Because you're reducing your risk, you also get less deductions. So this one, maybe if you are someone who doesn't want to take that much risk, then you can look into these royalty options. So you have both options that work for you. And that's why I said that you should not just go online and pick a random company and just put your money in there. You really do need to connect with the right people, really understand how the royalty works, how the working interest works, and only then choose this route. So what are some of the risks associated with oil and gas? The number one is oil prices. Oil prices are always changing. Sometimes they're up, sometimes they're down. And obviously during the up market, like what we saw in the last few years, it was awesome. But in down markets, that can have a major impact. Well performance, like I said, some wells can perform 20, 30 years. Some wells might be 5 or 10 years. So it really depends. So more information you have about the well, the better it is. And then there are environmental issues, but obviously a lot of people have been making a case for EVs and using nuclear energy and so forth, and they're claiming that extracting gas is actually not environment friendly. However, the newer technology does make drilling safer and safer for environment as well. So both for humans and environment. But nonetheless, those risks do exist. Okay. So, like I said, I gave you this example earlier. $100,000, you get about 60 to $80,000 in deductions from your income taxes. Oil produces gas for next 20 years. That means every single year you will get a paycheck, and out of that paycheck, 15 to 30% of your income will be completely tax free, but you do end up paying tax on that 70 to 85% of the income. So why should you look for it, or who is it this right for? Obviously, you should be in high earner, people with high W-2 incomes, people who have stock options, business owners. Those are the people who can benefit from this quite a bit. You should be an accredited investor. Most of these companies don't want to get involved with somebody who doesn't understand investments, who doesn't understand risk, who doesn't understand that sometimes you might bet on a well that doesn't produce anything. Although, like I said, you can reduce those risks significantly by working with people who understand this industry very well and eliminating a lot of bad options. But still, at the end of the day, risk always exists. You just never know what you don't know. So no matter who you talk to, no matter what somebody pitches you, there's always a risk. So generally speaking, if you are not comfortable with the risk, if you're not comfortable with losing your investment, then you should not get involved in it. So we call them accredited investors. So only then, if you are an accredited investor, only then you should consider it. If you're not an accredited investor, I encourage you to learn about risk, rewards, how do you manage risk, how do you diversify, learn all the basics of finances before getting into some of these aggressive strategies. At the end of the day, you're looking for some sort of diversified way that helps you reduce your taxes and help you build an income portfolio. So keep that in mind. The US government wants to maintain energy security, so it provides tax incentives to encourage investment in domestic oil production. Same thing with EVs. So US government obviously wants to become independent when it comes down to oil, gas, solar, EV. So that's where you'll see a lot of these tax incentives. Like I said, couple of things to keep that in mind. I think some of you guys will probably care. One is that the drilling methods are changing all the time, and they're becoming safer and more environment friendly than they were a few years ago. And then there's a lot of water being used, so there's another case that people oftentimes make. And once again, I would say with the modern technology, that is also becoming a lot more friendly. So I'll leave you with these three things. Number one, you get a huge tax benefit. You write off most of your investment in the fund alone. So that's a big benefit. And you can produce income for a long time. So let's just say, do a simple math. $100,000, if it can produce you, let's say, in 10 years, can double your income. Most people with S&P 500 expect to double their money in about 7 years. So even if, let's just say we do 15 years, even if we do it years, that means double than S&P 500. Still not a bad idea because you're getting a tax write-off from day one. Meaning, let's just say let's say you are $100,000 income and you're able to write off 80,000 of it. That means you're not paying taxes on 80,000. Let's say if you were in 40% tax bracket, that is almost $32,000 you saved in taxes. And you can take that money and put it into S&P 500, put it into real estate, and that money will continue to grow. Here, you're getting that tax benefit and you're getting income for, I wouldn't say for life, but at least for 20, 30 years, providing you pick a good company. So that's the basics of how oil and gas investments work. So if you still want to learn more about this, you want to talk about what are some of the best companies to work in oil and gas, you want to understand the tax implication on your particular situation, you want to compare it with some of the other alternatives out there. Should I do short-term rental? Should I become a real estate professional? Should I do solar? Should I do cost segregation? Should I use some other tax strategy? If you want to compare your options, you want to understand which one is a better fit for you, then please set up a personalized consultation and I can go over all kind of different options for you, and we can calculate numbers and see which one will make sense to you. A lot of time people don't realize that US government want us to take certain actions that are essential for the US future. So for example, these strategies that I'm discussing with you, oil, gas, solar, businesses, real estate, the Congress wants us to do these things. These are not some illegal transactions or some shady tax loopholes or anything like that. This is what the US government wants us to do, but we should not do it blindly. I see so many times people just randomly go and do stuff without understanding what is better, you know. Um, unless you compare different things, you would not know. So anyhow, if there's anything I can do to help you with that, don't hesitate to reach out. I'm licensed in all 50 states, so I work with clients throughout the country. If you are a high W-2 earner, or maybe you have a big capital gain and you're looking for ways to reduce your taxes, then I'm here to help answer any questions you might have and do some calculations and find you a way out. Thank you so much for spending your time with me, and I'm looking forward to seeing you at our next event. I think next event, I'm recording this in October 2024. So next event will be on November 10th. We call it the Wealth Summit. We attended by 500 plus people looking for ways to build wealth. So if you are in the area, I invite you to join me there. Thank you so much for joining me today, and I'll talk to you soon. Bye bye.